So, do you see prices of goods increasing around you? Well, that's inflation. Let's talk about it. Join me. Hi, folks. Welcome this week to our podcast, The Way I See It, which is a podcast about the economy, money, finance, politics, and that intersection. We want to talk about all those topics and see basically how they interact and what we could learn from them. This week, I want to talk about inflation. We hear about inflation, we can't escape it. So it's a good idea to just understand what is going on with inflation and how can we avoid it if possible, or can we mitigate it? Yeah. So what is inflation? Very simply, inflation is the general rise in prices in an economy. So how inflation is measured is that the economists will usually have a basket, and in that basket they will put in various should we say costs of various expenses in the economy. For instance, they could put in rent, they could put in gas, they could put in recharge cards, they could put in childcare and all that, food. And then they measure that basket week or month by month. And as the basket goes up in price, i.e., the cost of that basket goes up, that's an indication that the prices in that basket have gone up. So, of course, that then means that inflation has gone up. So that's basically how we measure inflation, through the consumer price index basket. Yeah. So the key thing to understand again is this: prices are going up because money supply basically has been introduced into the economy. So when money is chasing goods, and there's more money chasing those goods, then inflation then tends to rear its head. Yeah. Two types of inflation. There's the cost push and there's a demand pull. So just like the name says, there's a cost push, i.e., the cost of those rents, all the food in the basket are going up. And as those costs go up, it's then reflective in the market prices, which then causes those market prices to then appreciate, say, month by month. And that's basically what shows up as inflation. Same thing with demand pull. People want to buy, say, certain items. For instance, people want to buy tissue paper, or people want to buy water, maybe during a pandemic, maybe. So that tends to then increase the demand for those products. And then if the supply isn't there, it then tends to increase the prices of those products. And that then shows up as well in inflation. And a good point to then make here is about supply. So, like we defined inflation as a general increase in prices, it's important to note that supply, it's basically what ameliorates, or is the lack or the presence of supply that basically indicated there's going to be inflation and how serious it's going to be. So imagine if you had an economy where you had a bar that was selling beer, for instance. If there's a lot of beer being sold, or if a lot of beer is being demanded, and there's no supply, what happens? The price goes up, right? But what if lots of people want to drink and there's a lot of supply way in excess? Then the price can go up, especially if there's not just one bar, but there are lots of bars. There are substitutes. There's orange juice, there's water, there's milk. So it's very difficult for beer to go up in price because, number one, there's a lot of supply of beer, and number two, there's a lot of supply of substitutes of beer. So if you increase the price of beer, consumers will simply move over to, say, milk or orange juice. So supply is also a very, very key point in inflation. If supply, i.e., production, is increased thereby productivity gains in the economy. If the companies can produce more goods at a lower price, yeah, they can increase the supply, and then that tends to tamper inflation. So if the government, for instance, were to give everyone a stimulus check, and then that increases the money supply, if there was a corresponding increase in the supply of goods and services, you can see that there might not be inflation, because all that money supply is going to be soaked up by that increase in the supply of goods and services. So, important point to note: supply is very, very key. There's cost push and there's demand pull, and all these basically give us the basis of inflation. Yeah. So let's talk about how we can fight inflation. Let's talk about the government side. When the government wants to fight inflation, there are basically two things they can do. They can try to reduce the amount of cash that's in the economy. So the central bank can perhaps say, hey, we're going to issue bonds. The idea being that they can draw money away from the banks and then just give them paper. So the banks don't have physical cash to lend out. That reduces the money supply in the economy. Yeah. Or the central bank could basically say, hey, we're going to boost the economy by allowing organizations or companies to then produce more, either by giving them incentives so they can produce more, and that those goods could then supply the economy with goods and services, and that would then soak up the excess cash that's in the economy. That's basically what the macro guys do. That's what the CBN does. But for us, more importantly, how do we fight inflation in our portfolio? Well, inflation affects different assets in different ways. If you had a portfolio that you had, say, fixed income, and then you had, say, variable income, let's say you had a fixed income portfolio of, say, bonds, how would it affect you? I would say very, very bad, because the bonds pay you a fixed return. Yeah. So if you get a fixed return and then the inflation goes up, what it basically means is that that's those streams of payment being made to you are subject to inflation. It's easier for inflation to eat them and reduce their value over time. But what about equities? Well, equities are more or less variable income. So that means that the return isn't fixed. It can go up, it can come down. And then you can make the argument that, well, maybe a company can increase prices or the prices will go up because of inflation. And that gives you a bit of a hedge or a bit of a protection from the effects of inflation. So you can see, for definitely, we know that if you have a fixed income product, it's bad with inflation. So pensioners, people that receive a fixed salary, tend to do not so well with inflation. But guys that then sell assets or own shares in companies that sell assets or commodities tend to do a lot better, because those commodities tend to be sold at inflation plus prices. So the prices go up because of inflation, and then they tend to do a lot better. So what we'll say, the bonds then offer you stuff called the treasury protected bonds, whereby the interest rate that the bonds pays is indexed to inflation. Those bonds are there, and that you can buy them as well and sort of protect your portfolio. But the key thing to notice this: you really can't avoid inflation no matter what you do. All you can do is to mitigate the effects of inflation in your portfolio and your savings. So that's why you have to build a portfolio. You simply can't just have one investment. If you have fixed income, have a bit of a variable income, the proportions may differ based off your risk profile and your objectives, but you want to have a portfolio just to protect yourself against inflation. Even currencies, yeah, you want to say, can I keep different kind of currencies so that I can protect myself from a loss in value of a currency due to inflation? Yeah, so very important for us to have discussed this. Inflation is global, it's worldwide. It's important that you understand how it affects just not your portfolio, but what brings it about if you're an entrepreneur, if you're just an investor. Yeah, I think we'll stop here. Like I always say, tell your friends about us, share us. We're available now on all podcast channels, Google Podcasts, Stitcher app, and all that. You can listen to the Way I See It podcast and all those guys. And you can also follow us on Twitter, Finplan Calo Ajo 1. That's Finplan Calo Ajo 1. Thank you guys for listening. Appreciate you guys all the time. Have a good day. Bye.